A lot is going on in this marketplace. So let's update the driving factors and the force between what's happening with the interest rate, real estate, and the recession. Let's talk about it. Let's get right to it. So I am going to share my screen here. And when we take a look at the current marketplace, so inflation is a big buzzword right now. So we have got inflation over 8% now as measured by the consumer price index. And while it might peak temporarily over the summer months, we could see a comeback. Inflation is the arch enemy of the mortgage rate because the receiver of those mortgage payments typically receiving a fixed payment over a long period of time, and the inflation makes things cost more. So the money doesn't go as far as the receiving is a fixed payment, but it buys less and less. So the only way that you can combat higher inflation if you are the receiver of the mortgage payment is to charge a higher interest rate to offset the more rapid rate of erosion. And a lot to talk about to the Fed, and we anticipate that the Fed will be hiking interest rate quite a bit this year, but it doesn't necessarily mean a bad thing for the mortgage rate. So the other big buzzword is recession. So we have been talking about this late 2021 and in our forecast for 2022, where he said the early 23 looks like a recession was on the horizon. So what does this mean? And what does it mean for the mortgage rate? And what does this mean for the housing? Let's take a quick look. So the first, let's take a look in the Fed and do a quick recap. Now, if we all go all the way back to the 70s and the 80s and the late 70s, so the Arthur Barnes was the Fed chair, and he watched the inflation go from 7 to 14%. And as a result, remember we say the mortgage rate have to go up when the inflation goes up, and it did. It actually went to from 12% to 18%. The Paul Volcker came in. He took the Fed funds rate already at the 11% to 20% within 2 years, slowed the economic enough so the inflation went away and way down. And the mortgage rate is because inflation dropped. Mortgage rate went down from 18% to 12%. So the interest rate went up, mortgage rate dropped, but there was a recession. But just about every time when the Fed strive to slow the inflation and the economic by hiking the rate, we get a recession and the stock market didn't like it. So under the Greenspan, he also saw the inflation rise. So and as a result, the mortgage rate rose just like we have been saying. Now he took the Fed funds rate almost to 2% within a year and slowed the economic enough where the inflation dropped. And because the inflation dropped, the mortgage rate dropped from the 8.5 to 3.5%. So think about the hiking rates. And because he slowed the economic enough to kill the inflation, mortgage rate decline. So pattern year, but again, part of the pattern is recession. Almost is unavoidable, and the best stock market is a performance. Our guide today, Jerome Powell, has been inflation go from the 1.5 to 8.5%. So the mortgage rates go down the 2.5 to 5%. So there's a possibility could take the Fed funds rate, which was at the zero, now he's bumped in its quarter, and there are thoughts that he could get to somewhere near to 3% in end of 2022, and that should cause inflation to drop. And that means the mortgage rate should drop toward the end of the year, and we think the recession is pretty much unavoidable. And the stock market, if you go by the history, it might be difficult for the stock market. So let's take a look at the last time we had been in this similar situation where the Fed was hiking the rate but had a balance sheet that they started to show to allow to run off. So it started at the end of 2015. In December 2015, the Fed hiked the rate, and what happened there is the mortgage rate actually dropped. And now as the inflation started to creep back in, the mortgage rate went up, but then the Fed hikes again and the mortgage rate will drop again. So very constructive to learn from this is because we can see the mortgage rate drops while they are a little bit elevated. Now there's a bright future, even though the Fed is going to hiking. But once we get past the period of the Fed to run off, and we can see the interest rate actually is going to be drop again. So now you have been hear a lot about the inverting and the inversion in the yield curve. A lot of times what that means is the 10-year treasury is yielding a lower rate than the 2-year of treasury, then that's abnormal. The longer you tie your money up, the bigger the risk. You should get a great reward. And when this happens, there is a great indicator of the recession. Now in the past year, we have seen the spread between the 10-year of a treasury. When you take that yield minus a 2-year, it stays positive, but it's getting closer and closer and closer until we just recently it went upside down. In the 2-year was yielding higher than 10-year. That has a lot of people saying there could be a recession, and we agree with that. So as you can see, it's been pretty reliable throughout the history in the 70s, 80s, and 90s. Every time you get that inversion, a recession follows. And once again, in 2020, late 2020 versus 2019, the 2020 recession before the COVID, and now we have it again. So while the history may not exactly repeat it by itself, it does trend to rhyme. So what that means is if we have a recession now, and there's another indicator that we want to watch out. And one very reliable one is unemployment rate. So when the unemployment reach to the lowest level, it starts to rise, and it becomes a great indicator that we are going to have a recession. So as you can see, go back to the 40s, the lowest rate start to rise recession, and again and again and again. So every time with 100% accuracy, the most recent one is here where we are today. It could, so could we go a little bit lower? We have where we have a start to move up in the unemployment rate. Not yet, but perhaps later this year, as the Fed raise hikes start to take a hold and we start to see the things slow, the employment rate start to pick up. As you can see, a really reliable forecast of the recession. So what does that mean when you have a recession? Is that a bad thing if we get one? Like we are thinking of end of this year, early next year. Well, as far as the mortgage rate are concerned, we haven't been seeing the drops in mortgage rate. Every single recession as by quite a bit. It might add as we haven't seen the mortgage rate drop. Okay, so the recession have to be bad for the real estate, right? Well, not exactly. As we look at the real estate history, you can see in the late 60s, 70s, and 80s, 90s. So every time when we have a recession, the price actually did pretty well and it went up quite a bit afterwards, even in the early 2020s. The one abnormal here was the housing bubble. So when you have a zero down, fog up a mirror loans when you are doing no income, no asset, no job, and a poor credit score, and you are still getting the mortgage on the multiple homes, well, that housing bubble was overcooked. And that actually led us into the recession. It wasn't the recession that caused from the home price decline after the finding our footing. You could see the price have gone up quite a bit since then. And actually, the last recession, true to form of the previous one, is other than this one this time. So 8 to 9 recession, home value going up, continue higher. So we believe the housing market today is pretty strong. If you can take a look in here, because in 2007, there was a lot of inventory. It was nearly 3.7 million units for sale. Today, well, with much less than million units for sale. So that's a lot less inventory. But meanwhile, the housing costs since have grown. So you could see the households are much greater than were there in 2007. So you have got 14 a million more households fighting for the 3 million fewer homes. So we think that while we have a period of time here to contend with the future, it does look pretty bright to us.